Good evening. This is the Elliott wave update and also a little bit of the big picture update for the S&P 500, the NASDAQ 100, and a quick review of the 30-year and 10-year notes, and then also a quick discussion on gold and silver. I will be also publishing a little bit later part one of my big picture update, which I recorded yesterday with Dan Ascani, and that'll be coming up later this evening, most likely. In any case, let's get going. We've got a lot going on as we ended last week. Starting here with the S&P, we did see the market come down. They did attempt a couple of times and did end up pushing back to that 4,100 level, but we did begin to see that line, that wall, so to speak, start to drop from 4,200 down to 4,150 and eventually down to 4,100 before the expiration actually occurred. Now, today, when Globex opened, the market did zip real quick up to 4,109, I think, or somewhere up in there, and then immediately sold off. But it's not selling off massively. In fact, right now, as we come on to record, it's down 450 in the start of Globex. So it's still sitting up in higher levels, and I suspect that that's the way it's going to remain, more than likely until at least the Asian markets are open, and then again, the European markets. Now, at the moment, the market continues to be more guided directionally by derivatives, by the derivative trading, and where certain Greeks like Gamma and Vega actually, because we have a big number coming out on Tuesday, and that's going to be the CPI. And that will decide direction, and it will definitively decide direction on Tuesday. But there's now a lot of play in how will that number present itself? How will the data come out? Is it going to come out and show a continued improvement in inflation or a continued disinflation? Or is it going to come up and resume that inflation is again on the rise? So I'm not really hearing anything that's stating that, well, this is what they think is going to happen, et cetera, et cetera. In fact, I could probably see if I can't get a hold of that and look at the consensus, which is out. But then again, this has been known, and it was known a while back. So the consensus is that it's going to come in month over month plus 0.5%, and that year over year now, though, it's going to be down to 6.2. So it's going to be interesting how this all plays out and how it gets interpreted as we move forward with the interest rate conversation. And as I have been discussing, that the markets continue to pay close attention, but they roll and kick the goalpost down the road a little bit, so to speak, because it's always that we're waiting for additional number to show us that what we're being told by the Fed, what we're being told by a lot of economists, what we're being told by a lot of the internal analysts at some of the bigger banks, the biggest banks, continue to say that the United States is likely going to be dropping into a recession. How severe that recession is going to be, who knows? But there's still a lot of play. So we've got that hanging out there. And so when we're dealing with the options, there's a lot happening in the volatility options. There's a lot happening in the SPX options. There's a lot happening in the ES options. And then some of the internal component companies, of course, there's a lot happening in those. But primarily, we have the Treasuries and the equity indexes front and center, and how that's playing out via the options. So we're going to keep a very close eye on that, because there's two camps. There's the one, what happens if they do like the number, that it does show an improvement, and it becomes as the surprise. Well, we've seen in the past where we can get a pretty big reaction from the market, a very, very large reaction from the market. And it would be in line with what's happening, again, in the options, the volatility options, the SPX options, the ES options, et cetera, because there's going to be a lot of adjusting going on in those positions. So, and then there's also what happens if it's the opposite. What if it's a shock to the market? Same type, we can get a very big reaction. So we got a lot of sitting on the fence. I would imagine a lot of things going to be going on leading up to it. Right now, in the S&P 500, I continue to leave open the potential. As you can see, I've not filled any 4 and a 5, and I've left the 3 up there. So that suggests that we did on Friday come down and basically touch that 382 support level, the fib support for a 4th wave. And so we have continued support down below at 4013 or 4014 with the daily now, the daily 50 sitting at 4,000. So we've got that downside kind of pretty much capped off at 4,000 right now. So I have to leave open the possibility that this market is actually going to go back above 4,200. Now, upside reaction, as we have seen in the past, for it to go 200 points from here, sure. And off of Friday's close, which is right around 4,100, yeah, it could. 100 points? Come on. Definitely. That's if we all started at this level. We could start lower and still do it. So again, cannot roll that out right now. Needs to remain in, and we're hanging our hat on Tuesday on the CPI number. Now, just to take a quick look, what else may or may not be coming out next week? Well, of course, we have jobless claims on Thursday, Philly Fed on Thursday, and PPI final demand on Thursday, all at 8:30 a.m. Eastern. And then on Wednesday, we have retail sales, industrial production. Industrial production at 9:15 Eastern and AM, and then the retail sales at 8:30. So the biggest one, CPI. And then again, we have Philly Fed and PPI final demand. So again, they're going to continue to kick it down. I'm not sure what, but it allows just these big guys to kind of maybe get their positions in order. But there's also, that what they consider is a lot of the asset managers, a lot of the larger ETF, those guys that manage inside of there, have seen a large influx, and they've come into the market and they put a lot of money into the market. And we've seen some of the money coming into, for example, in big moves that we're seeing in Microsoft, big moves that we've seen in Tesla, big moves that we've seen in others when they start to rearranging and doing everything. That it could be at risk. If we have a disappointment in the CPI number, then that money becomes in risk, and they talk in terms of 46 or some odd $billion would come back out, and so that could produce a real flush, a big boom, an air pocket, as the selling would be heavy. So again, we can have heavy upside, heavy downside. So we're sitting in the middle. Right now in the S&P, again, support remains at that 4060 area, and then we have 4014, and then we have 4,000, just because it's a big number, and that's where the 50 is sitting. Upside, continue 4,000, 116.17 up to 4120. That works. Then we have 4208, which is just the old. That's the high, not the old. That's the high from the end of January, actually. Nope, sorry. February the 2nd. Now, what I want to re-add, so we got the support. I'm going to take those off because we get too many on there and it looks confusing. And we're going to go up and we're just going to add for the upside. We're still working a C wave, an intermediate C wave, not an intermediate, an intermediate B wave, and it's a minor C wave. So we still have 4208, and that also coincides with 618 resistance, and that actually works because often wave C can be 618 of wave A, and that's not uncommon. It's actually more common. So that works, but I'm leaving open because this still looks pretty corrective to me, which leaves another little pop that the market would need to do. Now we're confronting the same situation a sudden downdraft and starting to break down, then it's going to turn into, yep, we're going to put the 3, the 4, the 5. Because if it really starts to come off, and it can 100 to 200 points in a disappointment, purely while these positions get adjusted, while all of this new money comes out potentially, plus whatever else needs is going to be coming out potentially, what's going to be moving, through the system on other, all of the individual stocks, everything. So there's a lot of money that's going to be shifted and moved, if disappointing. But also we have that volatility that's going to be tested. If it gets tested to the upside, there will be a lot of adjustments that will need to be made there as well. So continued upside. 42.66 is one area, but now I'm going to drop down at least to the 4-hour, and let's open this up and add one more level. If indeed the fourth wave is in, that means we're not going to come back down and test a 40.60. So then I'm going to be connecting also in extensions. I'm going to go, let me go a little bit wider here. I'm going to pick up from where wave 3 started to where wave 3 completed, down to where wave 4 possibly completed. All right, we leave that open for right now. Then we have a double. Again, 42.08. So we got a double there. I would suspect that we should, not unless it's like somebody pushes makes a mistake, we get up there and it's like the next one is just an absolute trashing of the market. We've seen that happen as well. But I would think we're going to push higher quicker, pretty quick. If any surprises, we're going to come to the upside. Above that, we have 42.55 to 42.67. And then we're looking at 4,300 to 43.67, but stronger 43.35.21, all above there. Can the market do that in a blast? It could. And sincerely, it's not that suddenly everybody's getting convinced that the Fed's going to continue to lower or ease or anything. It's really going to be based on positions that are being held and have to be adjusted to what just took place. So again, it could be a pump straight up and an absolute devouring straight back down, a rejection. Now, that would be more in line with what I would suspect, because this is not a new bull market. This is still, we're in a larger corrective season, you could call it. And therefore, we're not going to be just, okay, we're going to start going up, 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 up. Because it doesn't fit. It doesn't fit even the personalities of what's going on. What we would be looking for is not the threat of higher rates, but a consistent lower rate. We would have to, we would need to see evidence that the inflation rate is coming back to a 2, not just farting around between 5 and 6 or 6 and 7. So again, when we're not seeing any evidence, but that doesn't mean the market won't do it based on other positions that are at play. And this is something that I talk about and with Dan as we talked yesterday, and that these things come into play, and what's really causing them is like take a step behind the curtain, which I'm trying to do, to say it doesn't really have anything to do with the fundamentals or just with what's really happening or being expected to happen, that the Fed's telling us they're going to continue to have a stronger stance on raising rates. So that's not groundwork or laying foundation for a bull market or for a rally. So this is a counter trend rally, and the trend remains down. So whatever happens to the upside, I think it blasts, and then maybe it's rejection. So again, those are the levels coming in. Now I'm going to take that off because that's kind of, we're leaving that possibility in, right? So, but on the other hand, I want to show if for some reason all of this is done, right? Now I'm going to go back out to that daily chart and let's just take a peek. If all of this is over, what are we going to do then? Well, we're going to be going down in a C wave. So if I have to consider this done, I'll even take it up to maybe 42. But if I'm going to take it right to there, which is 42. So if I go from here, again, I'm going to use extensions. And we're going to put it down to there and then back up to there. So essentially, we'd be looking for, this would be intermediate B, and we're looking for an intermediate C wave down. And so our initial support starts to come in at 4,000. So right there, initial move, easily come down to that 4,000, which is where the 50 is. That would be initial. Barely. If it's a surprise, it's going to go right through it. Then we have 38, I'm going to say 3,900. Then we have 3,800. Then we have 3,700. You can see our support comes in, falls, it's 100 points, falls, it's 100 points, falls. So that's what I'm talking about. If it gets there's no support, it just starts to fall. And as we got it at 3,700, we got it. Then it starts to get a little bit tighter. Then we have 36.25-ish, and then we have 35.60. Ultimately, 33.83. Now we're talking C wave. So we've already have where the expectation should be that we're going to go below 35.02, which was the low in October. But there's a lot of people that want to consider that October low. That's it. That's the bottom. And what was the bottom? And it was the bottom for several months. I'll give you that. But it's a B wave, and we're still looking for another wave down, and we'll break that. And so our support truly comes in 32 to 3,000 and just a little bit below. But that's, as this move progresses, we'll be able to fine tune that. But eventually, I am expecting it, whether it starts here or whether it starts here. Doesn't make any difference to what the outcome is going to be. I would still be looking for a break below 35.02. All right, I'm going to go over to the NASDAQ, and then we're going to go do a little bit of talking on the bonds. In the NASDAQ, it is actually the same story. This one came down a little bit further. So, but again, it's challenging to say that we cannot, or that there is no longer a possibility that the market is just going to do a little screamer here. Now, a couple of things we can put in right away. We can put in where, if indeed the wave 4 is in, let's take a peek and decide what we can do in terms of the daily chart, right? We have 12,726, or excuse me, 62. That should be exceeded pretty quickly. Then beyond that, we do have 12,950, which is just the previous high. That should be maybe provide a little bit of resistance, but should be by Tuesday, if that is a positive or the market receives it as positive result, we're going to break 13,000. And I think we do it pretty quickly. Again, so we have to leave open that possibility for new highs. And then we have 13,083, 13,342. Now that's based on this being the end of wave 4. Now, if the market does not, and then again, I'm going to put up one more, which basically will give us the expected, or what we've already known, for the C wave. So we do have, again, we got a little bit of a double right here. We have just above 13,000, which makes a whole lot of sense, and 13,083. So again, it depends also what we do during the week, because we still have 12,960, and our wave 5 would just need to get above wave 3 and still be able to count 5 waves up. So again, the opposite of that would be that we're going to go in the other direction. We don't get that run up. We get a corrective move that's going to really slam dunk the market going down. So this 3 would come down, the 4, the 5, and now we're working into a 5 wave. I don't have any evidence of that as I continue to discuss, but I cannot now say can that happen. So I am continuing to lean, because you can tell I'm not putting the 4 there, so I am still looking for the market to move higher before it goes strongly or more strongly lower. If we get a negative reaction, so we get a negative input from the CPI on Tuesday, I would suspect we're going to fly lower as we would fly higher. And again, it's really in the options positions, and it's really in the volatility derivatives that are kind of spelling out what possibly could happen. We have seen it before, and that's where the comparisons are being made. Now, I want to add downside, and that would be that we need to go from there to there to there. If that's it, that's all we get. And you can see that the drops come in and they just start to go. So I would be looking for the market to start breaking down. 12,181 would be first support, but I'm looking for it to break that. The 200 right below it. Again, daily, this is on the daily chart, the daily 200, the daily 20, bust through those just cleanly, boom, gone. And then just start heading down to the 50 and then 11,700 and then 11,000, keep on going. I think of the negativity, it would just reinforce exactly what the Fed is doing. And pretty much the bond market should be puking its guts out. Because, and I'll go over that as soon as I'm done here, because the message in the bond markets is pretty strong from right where we are. And so we would get pretty close to making a stronger choice, but I'll lay that out for us in a minute. So I think here, same deal. We got the upside, we got the downside. We're going to be looking for one. I'm not expecting a whole lot. We might get a lot of movement tomorrow intraday, but I think it'll be like an intra this. It'll build a range, and we'll stick to that range, maybe pop above or below. And that's what I think for there. Let's move quickly and let's start taking a look at least at the 30 and a 30-year bond and the 10-year note. Again, on the daily chart, I have been counting that the bond price has done 5 waves down, and that's over the all-time highs, and it's back into 2020, July, August of 2020, as when the bond market, bond prices topped, bond yields bottomed. So right now, what we're working on, 5 waves down, is followed by 3 waves, an ABC counter trend move. And so what we've got is the A, and I've been working thinking that, well, could this be all of B? In which case then we're in that finishing C wave. But nope, we only got so far, it stopped and came right back down. So either what I'm thinking it could be is that's A, B, and then 1, 2, 3, 4, 5 in a C wave, boom. So rates will appear to go higher, right? So as I discussed, that the 30-year bond finished last week at 3.83. So it was a 20 basis point hike move in interest rates in the yield via the 30-year bond, because the week before it closed at 3.63, then it's 3.83. So we're knocking on that 4% again. Now, what we need to pay attention to is that the market may, I mean, our next support is right here, 124.31, but also down to 124.11, which is the previous low of what would be the B wave. But it could stop right there because it could be just a flat. We have additional support down below at 123.08. Now, being that this, to me, is an ABC, so this could also be coming down. And we have to, and I'm fortunate, give it that room. Now, if you're trading bonds and you're trading these options, yes, you're going to need to position yourself a little bit differently, possibly, because the potential, and well, it will be made clear by the market itself, but we have to continue to at least expect a continued drop, maybe down towards that 124.11 area. That's an important support zone, or support line right now. A break there drops it to 123.08. And that's going to push the rate over 4%. So again, I've been talking that the market's really been holding between 3.5 on the upside and 4% on the downside. And as long as that stays in, then I'm considering that I will consider and include that we should turn and make another run, getting ourselves back above 135 bond price. So that is moving closer to 3.5 rate price, yield, and possibly even a little bit more. But it brings 3.5 right back in that picture and holds it pretty firm for the 30-year, probably maybe even down to, and I'll show you in the 10-year note in just a second. So right now, this could be, and the volatility seems to be really being held to the 30-year pretty strongly. But what's going to happen is we need to pay attention to the 2-year note, what's happening over there. That went down and that started way before the rest. But that also, all of the markets, the 30 years reached 3.82, the 10 years reached 0.50 or 50%, and the 2-year note, the 2-year notes down 0.618 or 62%. So those are all very common levels for the wave pattern that is being put in. So if the 2-year starts to turn, these will go right with it. And I mean turn and start to head back up. So in terms of bond price or the note price goes up versus continuing to decline. So I would look for that to happen here as well. So a lot going on. We got to sit tight. We got to wait. But there's our level in the 30-year bond. Ultimately, if this move is complete, I'm going to draw additional because then it's going to become where's resistance for the way back up. But right now, we've got current levels. We got 129.25, we got 131, et cetera, et cetera. There are different levels that likely will come back in until we can clear it up and put in fresh levels above. Now, over in the 10-year note, it truly is the same thing. As you see, it came down, touched the 50% line. Now, here again, we saw a fairly dramatic move. Again, 21 basis points here in the 10-year note. We're on February the 3rd. It finished at 3.5. On February the 10th, it was 3 and almost 3 3/4. So big moves in a week, big moves. So again, we got to wait. We got to see what CPI tells us. We got to check in with vol. There's a lot of things, and there's positions in all these treasuries as well. So, and they have expirations on Wednesday. Okay, so we still have continued support on the 10-year note. We have it down to 111.18, 111.25 up in there. Now, if it's going to turn into a flat and it comes all the way down, then we're going to get close to that 108, 109, 110. It all becomes in the picture. If it breaks below 108.25, then we're starting to really move into where this corrective move is over and the larger trend's back and forth. And then I'm sorry to say, we don't want to. It's not going to be pretty. It will not be pretty at all. Because what we'd be looking for is that's it. And we're looking for another one of these, or at least a low below down into here. Okay, so quickly over into gold. Gold still hanging its hat, has not made things much clearer. I'm going to find it and see what happens now. You see it's kind of holding, but it's kind of a sideways pattern. That's a 30-minute chart. It's kind of holding. It's just nothing. So still looking like 5, and this is still corrective or counter trend to that. So maybe we do a little rally. We get back up to here, maybe back up to here. But then it would have to build pretty quickly. If this is a 1, that's a 2, or an A and that's a B, and we get a C, then we're looking for another 5 down. And that's more in tune to what I think I'm seeing in terms of this move. Silver, it's truly up in the air, and who knows anymore. But silver's very close to breaking that low. It didn't do as well in that, but it can go up, maybe equal that, maybe get back up to 22, 33, 35, somewhere in there. 22 to 20, 22. 40, I should say. So again, it has upside potential, but not out of control upside potential. More to the downside. And that's where I'm going to finish it up here. So again, as we go out, equities coming down a little bit more now. And let me just go over here. You can see there's the S&P kind of holding it. The NASDAQ drifted back down. And going to 12,300. We'll see what it does. Have a great evening. I, again, will get this posted, and then coming on the heels of this will be my conversation with Dan Ascani, and we discussed the yield curve, the inverted yield curve. So a lot of the discussion is right there. All right. Have a great evening. Next update will be on Monday the 13th.